it time to rethink the classic 60-40 equity bond portfolio? Well, 2022 was the worst year in decades for that allocation. It was down some 17%. This year, a traditional 60-40 portfolio would be up just over 11% through mid-November compared to 17% in the S&P 500. So joining us here on set now is KKR's Paula Campbell Roberts. She is the chief investment strategist for Global Wealth and a managing director on the Global Macro Balance Sheet and Risk team at KKR. It's great to have you here. You did just put out this report. Why is the 60-40 portfolio not working as well as it once was, and how does it speak to, as you put it in this report, this new macroeconomic regime?
Thank you for having me, Morgan. You're exactly right. In this new macroeconomic regime, the 60-40 portfolio is inherently challenged. Essentially, the portfolio that you might have created 5 or 10 years ago just won't work today. You saw the underperformance last year, but even going forward, what we're noticing is the elevated correlation between stocks and bonds, which means that bonds are not doing their job in the portfolio. So investors need to seek diversification, better income, better yield elsewhere. So that's the crux of the argument.
I mean, is it fundamentally broken? I mean, is this a new dynamic or new relationship between stocks and bonds that hasn't existed before for key secular reasons, or is it just speaks to the cycle we're in right now?
I think this is structural, and so we talk about tectonic shifts that have permanently altered the investing landscape. So from the energy transition, from geopolitical shifts, demographics, and the like, that is driving us into a higher inflation structure. And so that higher inflation bias, which is matched with the Fed and other central banks raising interest rates on the back of that, has really put pressure on large cap equities, for example, where higher input costs and borrowing costs are going to challenge returns going forward. So in public equity markets, for example, you can't expect the maybe 9% return that you're used to. We expect more 6% or 5% going forward. And then on top of that, if you think about bonds as a component of that portfolio, if you're not going to get that volatility dampening or that shock absorption function, then really you need, as I said, to find that diversification, that higher income, that higher return. You have to find that elsewhere.
Okay, and that differs. And what you argue is that diversification is going to be found in the private markets and in alternative investments. So what does that breakdown look like? And I ask that just as importantly, yes, there are pros to this, but it's still relatively new for individual and retail investors to be able to have access to this. What are the risks associated as well?
It's a great question. And that's really why we wrote the paper, because many individual investors are new to these asset classes. So understanding, for example, how to manage liquidity, how to compare private equity versus infrastructure versus real estate or private credit, that's really essential for individual investors to understand. So the upside is that you get better returns, for example, from the illiquidity premium. So the benefit of actually owning an asset and being able to improve either, the alignment of employees and management, for example, or make changes structurally in the company, that allows you to generate a better excess return over public equities. So that's a key part of it. The challenge, of course, is understanding the liquidity, right? Because you're going to have to feel comfortable locking up your cash, for example, for 2, 3, or 4, 5 years, depending on the asset class. So that's really the trade-off, but there's a huge benefit to doing so.
Well, here's the part that has me a bit confused, Paula. So if you're your typical retail investor, maybe you've got 6 figures or a little less overall to invest. How does this apply? Because so many retail investors these days are underexposed to fixed income. They're nowhere near 60-40. They might be more like 80-20. And the yield that you can get on fixed income in a CD or in a bond fund is much higher than it was a year ago. So it seems like some people ought to be moving more toward fixed income, if not 40%, at least maybe 20, 25.
Thank you for the question. We certainly agree that fixed income looks more attractive maybe next year and the year after. But my concern with fixed income long term is we still expect inflation volatility. And as rates then settle and start to potentially rise later on, you're going to be challenged again from a fixed income perspective. So, by the way, what I'm saying is that a balanced portfolio still includes public equities and fixed income. We're just saying that purely investing in public markets, in stocks and bonds, is insufficient. What I'm really advocating for is giving yourself more ways to win, right? If bonds underperformed last year and underperformed this year, yes, they might perform better next year, but why do you want to be subject only to that volatility? Leaning into private credit gives you some of the same benefits that you just talked about, which is higher yield given where treasuries are. But then on the back of that, especially if you're in, let's say, asset-based finance, you're getting a bit more of that inflation hedge. So as opposed to being locked into just a single or 2 asset classes, really look outside of that opportunity set for more ways to win.
So if you're not really high net worth, what's the first lowest risk, if not low risk, but lowest risk step into that space?
We have a range of portfolios that we've devised for individual investors, especially those who are newer to private market investing. I'd say the Generate Income portfolio is great for those who are newer to investing. So that's where you'd allocate into private credit, for example, infrastructure and private real estate. You get the benefit of boosting your yield, but also accounting and hedging against inflation. That's probably the best first step.